Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. The Securities and Appellate Tribunal or SAT has set aside the SEBI's 625 crore rupee disgorgement order against NSE in the alleged co-location scam case, saying that it was patently erroneous. The tribunal also slammed the markets regulator for not conducting its own probe and instead asking the board to probe the allegations against itself. SAT also observed that SEBI's decision to disgorge 25% of the salaries of two former NSE CEOs was erroneous and set it aside. So does SAT's order change the whole course of the case? Find out in our next report by Bhaswar Kumar.
In April of 2019, markets regulator SEBI had directed India's largest board's National Stock Exchange to disgorge 625 crore rupees for alleged violations of the Stock Exchanges and Clearing Corporation regulations over lapses at its co-location facility. The NSE was also told to pay an annual interest of 12% to be calculated from April 2014 on the total fine. Under the disgorgement process, any party that is found guilty of profiting from an illegal act has to shell out the profit amount obtained from the said act. Now, about 3 years later, the Securities Appellate Tribunal has set aside the SEBI order, saying the NSE has not indulged in any unethical act or unjustly enriched itself. The NSE's former top executives, Chitra Ramakrishna and Ravi Narayan, also got some relief. But the SAT directed the NSE to deposit 100 crore rupees for lack of due diligence in following its own norms and circulars. This amount will be adjusted against what has already been paid by the NSE, while SEBI will have to refund any excess amount to the exchange within 6 weeks. The SAT also observed that there had been no finding that Ramakrishna or Narayan made any wrongful gains. It set aside the market regulator's direction that they disgorge 25% of their salaries drawn during a certain period. The direction prohibiting them from associating with any listed company, market infrastructure institution, or any other intermediary for 5 years was also set aside, substituted for the period already undergone by them. The co-location facility was launched by the NSE in 2009. It allowed traders and brokers to establish their IT servers within the premises of the data centers of the boards in return for a fee. These participants were able to access information about stock prices faster, resulting in faster trade execution. However, a whistleblower wrote to SEBI in 2015 alleging market manipulation by certain brokers using this facility. The co-location technology's implementation was carried out under the supervision of Narayan and Ramakrishna. The Central Bureau of Investigation, which has also been investigating the matter, arrested Ramakrishna in March last year. However, she was later granted bail. Coming back to the recent SAT order, the tribunal came down heavily on the market regulator. It noted that when serious allegations were made against a first-level regulator, namely the NSE, SEBI should have been proactive and conducted its investigation seriously. Instead, the SAT found that SEBI adopted a slow approach and placed a protective cover over the NSE's alleged misdeeds. The SAT also said that there was laxity at the NSE, which resulted in unequal distribution of IPs on the servers. Meanwhile, it allowed SEBI's direction to initiate inquiry against NSE employees. It also directed the markets regulator to consider the charge of connivance and collusion of OPG Securities and its directors with any employee or official of the exchange. The violations committed by OPG have been affirmed. As a result, SEBI has given 4 months to recalculate their disgorgement. The SAT said that OPG had remained connected to the secondary server in spite of warnings. OPG gained an advantage in accessing the data faster than other brokers due to a low load on the secondary server. The tribunal also pointed out multiple lapses in the various orders passed by SEBI in the co-location case, noting that there were contradictions in the findings arrived at by SEBI's whole-time member. Pointing out one of the anomalies, the tribunal said that in order against the NSE, the whole-time member held that an early login by the trading member and OPG created an advantage. According to the whole-time member, a trading member who logged in first would be disseminated the data first at the start of the trading day and would therefore have an advantage over other trading members. Meanwhile, in the OPG matter, the whole-time member held that the early login by OPG did not lead to any unfair advantage. However, the SAT has affirmed the SEBI whole-time member's decision to prohibit the NSE from accessing the securities market for 6 months and directed it to carry out system audits at frequent intervals. So, has the SAT order changed the course of the colocation case?
So the current SAT order definitely changed the course, the way entire colocation matter was being looked at. However, it is important to understand that the way colocation works, retail investors are not impacted in any way in this particular matter. Now, since the time this colocation related issues were highlighted, SEBI has already taken various policy measures. And in fact, the entire tick by tick facility, which was there at NSE, has been changed from April 2014. And now it has moved to something called as a multicast TBT. So therefore, such kind of recurrence of irregularity is minuscule. Also, one thing which needs to be remembered is that the order which has been set aside is not of the penalty order, which is a separate order and is pending at SAT, which is with respect to 25 lakh rupees penalty on the then MDs and CEOs, as well as the 1 crore penalty on the exchange. So this order is technical and not substantive in that sense. This is on the technicality on when disgorgement can be called, can be imposed, and whether this is a fit case for imposing disgorgement, especially when there is no finding of a personal profit being derived or computation of that amount in the SEBI order.
Also, what are the implications for the NSE and SEBI?
It remains to be seen whether NSE under the new management is going to appeal this order in Supreme Court, more so because NSE is looking to come out with its IPO in due course. However, SEBI situation would be tricky because the SAT order clearly nudges SEBI to introspect and put its house in order. It has remarked that SEBI was slow, casual in its approach, and was taking twists and turns depending upon what transpired at the parliament floor. These remarks are very damaging to SEBI, and hence SEBI will have to take a call whether to appeal this order in a full manner or in a limited way to seek only these remarks removed. As you know that in the Supreme Court of India, appeal against a SAT order is only and only on the questions of law, and SAT is the first appellate authority to decide facts and law both. So therefore, facts by and large have been determined in the SAT order. We'll have to wait and see how this entire controversy takes a new turn, especially under the new management and given the way exchange is looking to come out with an IPO. However, for introspection for SEBI, this is a sort of repeat of a history. And let me remind it that somewhere around 2007 and 8, SEBI had passed similar kind of a disgorgement order against depositories in a multi-demat scam called Rupal-Ben Panchal IPO scam. Even 2 decades back, Securities Appellate Tribunal's position was similar, that till the time profit has been calculated and arrived at, no disgorgement can be directed.
The order passed by Securities Appellate Tribunal is one another order of setting aside order of SEBI in certain aspects. It is yet another reminder to the regulator that SEBI needs to act very cautiously within the laid down legal principles, particularly in cases where it comes to conclusions of fraudulent activity and consequent disgorgement.
The tribunal has criticized both the country's largest stock exchange and markets regulator, highlighting lapses in their conduct of duties. This situation does not bode well for confidence in India's markets and should be rectified immediately.
SEBI is also busy drafting guidelines for financial influencers who of late have been giving a tough time to the markets regulator. Meanwhile, the central government has also come out with a set of guidelines governing social media endorsements. Under it, the influencers will now have to mandatorily disclose all material benefits they receive in exchange for promoting a product or service. There's also a provision for a 6-month ban and a fine or both for violations. So what impact will it have on the influencer industry? Tushar Verma has the answer.
The Department of Consumer Affairs has recently released guidelines to regulate the influencer industry called endorsement know-hows for celebrities, influencers, and virtual influencers on social media platforms. The rules are aimed at all influencers across social media and video platforms who will now have to disclose all material interests they receive in exchange for endorsing a product or service. According to a 2022 study, the reach of influencers in India has multiplied tremendously in recent years. On average, influencers reach more than 1 in 4 viewers on social and video platforms. 3 in 5 consumers are likely to try products after hearing about them from an influencer. Thus, if influencers impact consumer behaviors, how pertinent is it to regulate them?
I think regulations on influencers have been needed for a decade. I remember writing as far back as 2010-11, when blogs were very popular, and people we knew were taking money for endorsements or writing about things, and even on social media you could see that there needs to be proper disclosure, just like there were disclosure norms that were required for paid media in traditional news. So I thought it was natural for disclosures to be there in the interest of transparency for consumers.
The penalty for not abiding by the guidelines is high. Influencers failing to disclose or engaging in false advertisements will amount to a violation of Consumer Protection Act of 2019. In accordance with the law, a fine of 10 lakh rupees may be imposed, which may increase to 50 lakh rupees on repeated offence. Further, such influencers may also be barred from promoting and endorsing any product or service for up to 3 years. The Consumer Protection Authority, or CCPA, said the guidelines have been drafted to safeguard consumer interests. We reached out to Salman Waris of Tech Legis LLC to understand what prompted the government to introduce the guidelines now.
I think social media over the years have evolved, and in the last couple of years has evolved very quickly, at times blurring the lines between traditional media and social media, and also probably having more influence than the traditional media. So this was one space which was currently not specifically regulated as such. Even under the IT Act, there are no specific as such provisions dealing specifically with social media or social media influencers. So hence the need. So it's a gradual maturing of the market in the country, and the subsequent requirement.
Influencers in India are vastly spread. They range from financial influencers, food bloggers, to lifestyle influencers and fitness enthusiasts. Their age group is broad as well, ranging from kids below 18 to senior citizens. In fact, during the pandemic, when offline advertising rates fell, social media advertising grew by 46%. A study by digital marketing agency IQ's Wire indicates that micro-influencers, defined as people with 10,000 to 1 lakh followers, observed an increase in engagement by almost 60%. Salman Waris has a perspective on the ideal way to regulate such influencers.
The technology is evolving so quickly that there will be always a situation where the regulations themselves would be falling short in a very brief period of time. So while it's a good effort, I would say, and for the time being, maybe it's more important to have something in the form of a regulation rather than not having anything at all. Because we have seen that with some other laws, for example, the Data Protection Act. Since this is being done through the consumer under the Consumer Protection Act, so primarily the focus is the consumer and misinformation or the awareness of the consumer with regard to where social media influencers are advertising or promoting products. So to that end, I think it does meet the initial requirements.
The endorsement know-hows mandates some extra work by the influencers. The Department of Consumer Affairs, in its document, indicated that the disclosures must be prominent and extremely hard to miss. Disclosing only in the caption will not be enough. Influencers will have to superimpose the disclosure in case of an image. In case of a video, the disclosure must be in both video and audio format. Even live streams have not been left out. The document says that there should be a continuous display of disclosures. So, will such extra effort and due diligence prove to be an obstacle for young influencers with limited infrastructure?
I think influencers want to be influencers because they want to influence people, right? I don't think they do that bit for money. It's when they become influencers that they find avenues for making money. And it's a little bit of work, but they should be required to do that work for the payment that they're getting in terms of giving disclosures. But the problem is in something else. companies don't want you to disclose that they are paying you to do this, right? For them, the difference between running an ad and working with an influencer is that people are more likely to believe an influencer than an ad. People have banner blindness when they see banners. So they feel that people will trust something less if consumers know. But at the same time, by using influencers and not giving disclosure, they were effectively fooling people. So I think it's going to be that companies don't want disclosures. Influencers wouldn't have a problem with it.
Industry insiders believe that guidelines for influencers are a welcome step towards the regulation of an industry that has come of age. However, the guidelines should evolve with the evolving technology. While it may seem that due diligence is extra work, the influencers should practice it in earnest for the sake of transparency.
Moving on, equity markets have remained muted for most part of January amid pre-budget volatility. As we enter the last leg, how will the market trajectory play out in the run-up to the union budget? Rex Cano looks at the past trends to bring you the answer. Equity markets could undergo fresh bouts of volatility in the next 7 days as the union budget draws near. However, if historical trends are anything to go by, the market could see short-term positive momentum post the budget. As per data compiled by BS Research Bureau, the Sensex has fallen by 0.8% on average in the week preceding the union budget during the last 15 years. While on a month-long time frame, the average losses have been notably higher at 1.4% prior to the budget, though the Sensex has gained a mere 0.2% so far this month. On the contrary, the average weekly and monthly returns on the benchmark index following the budget have been positive at 1.2% and 0.3% respectively. Besides, the market has also edged higher in the budget day session and the following trading day on an average in the last 15 years, wherein the Sensex has gained 0.3% on the day of the budget and 0.6% the next day. Analysts say that a positive reaction by the markets is typically seen post-budget for a day or two.
So typically markets are either flat or rising a little ahead of the budget, and post-budget there is a positive reaction in immediate positive reaction in most cases, and then post 2 days it sort of that positive reaction withers away. Then people realize what is the actual outcome of the budget provisions. So that is how the markets behave. There will be exceptions when there is a very good budget in one of the years, a very bad budget. But otherwise, this is how it is sort of reacted to by the markets.
A study by Nuvama Alternative and Quantitative Research reveals that the probability of market gains a day after the budget remains high at 67%. Meanwhile, analysts at Morgan Stanley highlight that the union budget's influence on short-term market performance has been a steady decline, while volatility has risen since 2019. Budget day volatility was at an 11-year high in 2022. While post-budget performance is harder to predict, it seems certain that market volatility on budget day will be high, says Morgan Stanley. That said, markets will seek direction from F&O trends owing to the monthly expiry today. Among stocks, Bajaj Auto, Cipla, Dr. Reddy's, Tata Elxsi and Tata Motors will be in focus ahead of their Q3 results. Last Friday, over 2 lakh depositors heaved a sigh of relief when Bombay High Court set aside Yes Bank's decision to write off additional Tier 1 or AT-1 bonds. In today's Decoded segment, we tell you more about these high-yielding but unsecured bonds.
In the March of 2020, a news triggered a panic among lakhs of people associated with the Yes Bank, which had over 1,000 branches across the country then. The private lender was collapsing due to alleged irregularities and bad loans. It was then that the RBI stepped in. A restructuring plan was announced with the central bank superseding the commercial bank's board. Later, the government announced that the SBI would buy a 49% stake in the ailing private lender. 2 years on, financial results show that the bank's health has improved. But a decision taken by the bank and RBI administrator on March 14, 2020 has put over 2 lakh depositors in a fix. The decision was to write off its additional Tier 1 or AT-1 bonds worth around 8,415 crore rupees. And this decision has now been overturned by the High Court. The bank, on its part, said that it would appeal the order in the Supreme Court. But what are these AT-1 bonds that have led to this legal battle? Let's understand. AT-1 are a type of unsecured perpetual bonds that banks issue to shore up their core capital base and comply with Basel III norms. These norms were formulated after a string of banks collapsed in the 2008-2009 global financial crisis and called for maintaining stronger balance sheets. Under Basel III norms, banks are required to maintain capital at a minimum ratio of 11.5% of their risk-weighted loans. Of this, 9.5% needs to be in Tier 1 capital. AT-1 bonds fall under this type of capital. The AT-1 bonds are long-term and do not carry any maturity date. They also attract large investments as their face value is 10 lakh rupees per bond. These bonds carry call options that allow banks to redeem them after 5 or 10 years. They also carry a high rate of interest around 9 to 9.5%. But these bonds also carry a higher risk. The banks are not obliged to use the call option and they can opt to pay only interest on these bonds for eternity. They can also skip interest payouts for a particular year or even reduce the bond's face value without informing the investors. Moreover, if the RBI feels that the bank is on the brink of collapse, they can also simply ask the bank to cancel the outstanding AT-1 bonds. The same happened in the case of Yes Bank. Bonds worth 8,415 crore rupees were written off, leaving investors in a lurch. Now, with the court saying that the bank did not have the authority to write off the bonds, what becomes of the legal tussle remains to be seen.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
An investigation by SEBI has revealed the Yes Bank labeled these AT-1 bonds as super FD and individual investors were not aware about the risks involved while purchasing it. That's all for today. For more news and analysis, please log on to business-standard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.